Hello, everyone. Thank you for joining me. I'm Dr. Duru with Ahan Analytics, speaking with 122 for the market breadth. I know that was a mouthful. Anyway, I am starting today's review of the stock market action with Apple. In my last blog post, I also talked about Apple because I took it as yet one more sign that a bear market is getting deeper. And let's just say that Apple looks worse than it did yesterday. It dropped 1.8% on the day. It now has confirmed a 200-day moving average breakdown. So the 200-day moving average is this blue line. It's a very important trend line for long term because it's 200 days average. And this is a confirmed breakdown because I have two lower closes below the 200-day moving average breakdown. So on an individual basis, I consider Apple to be now in a bear market. I know the traditional definition is 20% off the highs, but a lot of times, particularly with these kind of steep uptrends, waiting until 20% off the highs can be a little late. So I like the 200-day moving average. It's a long-term trend line, and it's very important when a stock or index or ETF breaks down below that. You should take note, even as a long-term investor who wants to do buy and hold or buy the dips. So anyway, the way I use this is that Apple now is not a buy for me until it gets back above this 200-day moving average, or the market gets so oversold, so extremely sold off and down that it's hard to resist not to take a chance. And we are almost at that point, and I'll get into that a little later. So what's interesting is that if you look at the traditional financial media, and here is some of it, you'll think that, well, a soft CPI report was a major driver of the market action. So you see this one here, Tesla jumps on cooling inflation data, even as US registrations dip 11%. And then over here, you'll see down here, stocks rise after CPI surprise as trade risks loom. So these headlines both say that, hey, things went up, but why did they go up when there's other bad things? Well, the issue with the conventional headlines is they're always trying to find reasons for stuff. But I just want to look at the different technicals across the different um, equities and indices. So let's go one by one because yeah, S&P 500 was up, but it wasn't up that much. It only increased 0.5%, hardly anything to write home about. This confirmed 200-day moving average breakdown is still in effect. The S&P 500 is still in bearish um, position. And even on a bounce, I think that now this convergence with the 200-day moving average and this line that defines the bottom of the post-election gap is going to be tough, tough, tough resistance for the S&P 500 to beat out. Okay, next up, the NASDAQ. The NASDAQ also is a bigger winner today. It was up 1.2%. And what you'll notice when I look at some individual stock charts is that the NASDAQ was driven by having a higher amount of stocks that are high flyers, basically, stocks that went up in big chunks, 5, 10% a day. Um, and then in this recent sell-off have gone down 5, 10, 15, almost 20% in some cases for the super speculative stocks. So an oversold bounce is due to have at least a larger impact on an index like the NASDAQ, and that's what you see here. But notice, just like the S&P 500, the NASDAQ is in a very deep bear market based on this confirmed 200-day moving average breakdown. And now for the small caps, IWM, the iShares Russell 2000 ETF. I mean, it gapped higher and then it faded until almost flat. It was even down for the day at one point. So it only had a 0.2% gain, and it still looks like it's on track to eventually return to an official bear market, which would be 20% off of the all-time high. Okay, so let's go into now my favorite technical indicator, market breadth, the percentage of stocks trading above their 50-day moving averages. I call it AT50. You'll see here it was essentially flat on the day. It slipped a little bit, closed at 24.0%. It is teasing me because I wanted to hurry up and get to official oversold conditions so I can change my short-term trading call from cautiously bullish to just bullish and just go aggressively buying things. Until it does, I am buying a few things, but I just can't get aggressive. Um, the other longer term market breadth indicator, which I call AT200 for the stocks above their 200-day moving average, was actually up on the day 2.6%. So that's encouraging. And just as a reminder of how far down this has come, you can see it was last this low back in November of 2023. So, as a reminder from one of my previous blog posts, this tells me that there is a lot more potential for downside if this bear market deepens. Okay, so that's market breadth. So market breadth is saying, hey, caution. The market is essentially oversold, but not oversold enough to get aggressive because it hasn't AT50 has not hit my official oversold level. Let me pan out so you can see that better. There's the oversold level. And of course, I've been waiting a long time for true oversold conditions. The last time we got oversold was in late 2023. So anyway, so now that I've gone through that, let's take a look at some individual stocks because this was a weird day. I had my favorite technical indicator, AT50, actually fell a little bit. The longer term market breadth was up and small caps was flat. The S&P 500 was barely up and the NASDAQ was up over 1%. And so when you look at some of these stocks that I'm about to show you, you'll see why it was such a mixed day. So iRobot, big loser. 30, it was down 35, let's just call it 36%, new all-time low. So glad I took my losses earlier on this one. I wrote about it earlier and discussed first my bullish case and then why I had to give up. So glad I'm out of this. It's unfortunate. This stock was, as you know, a victim of a failed bid by Amazon to take them out, and they've been struggling and suffering ever since. Now, on the positive side, for instance, we have a stock like Credo Technology Group or Credo, and this one is one I pointed out in an earlier blog post as being a potential buy once it gets over its 200-day moving average. And sure enough, it did. But notice how big the move was. It moved the previous day, it was already up 10%, and I didn't expect it to pop as much as another 10% on the day, but that's exactly what happened. So, this it's a little tough to chase this, but the technicals are the technicals. And of course, Credo has a lot more upside if the momentum persists. So I went ahead, bought a sorry, not a calendar, a call spread between 50 and 60 for April. So I'm trying to give it both plenty of time and room to rally, assuming that the 200-day moving average will hold a support. That's my bet. Now, on the other hand, yesterday I got a little aggressive on the hedging side and I looked at CrowdStrike. I know that the market didn't respond well to its earnings, so I was skeptical of CrowdStrike when it faded back from 200-day moving average resistance. I put in an aggressive put spread that expires on Friday, and I got burned for taking that chance. CrowdStrike popped up above its its 200-day moving average, which makes it a buy for those of you who are interested in these kinds of cyber security or soft security stocks. Um, so, I take a big L on that one. Another one I covered yesterday in my blog was Tesla. One thing I did not note when I got the hedging put spread was that Trump had bought a Tesla himself to give Musk and the company a show of support, and the stock followed through with a massive 7.6% pop. So, I don't mind this because it supports my holding in ARK Innovation ETF, but I am suspicious about this pop. I don't think it'll sustain itself. So as a big time speculation, I went ahead and bought Tesla Q, which is the 2 times short daily ETF. So this is really speculation. If Tesla continues higher tomorrow, I'm obviously going to bail out of this and just enjoy ARK, hopefully continuing to go higher. But ARK is in trouble, still in trouble because it is in its own bear market. It's fully reversed its post-election gains, and it's still under the 200-day moving average. But as I've explained before, my trading strategy for ARK it involves just wanting to have a piece of this in case ARK ever turns things around and gets back to its former glory. I don't want to be left on the sidelines if that happens. Okay, let's take a look at some other plays because again, like I said, this is a mixed day. And here we have Spotify technology, and it is bumping up against the 50-day moving average. So it has never, even though the market is selling off, it never got down to the 200-day moving average. So it's possible it's not going to suffer that much of a drop in this downturn. But what I did, just like CrowdStrike, I looked at this and said, this looks like a tentative test of resistance. I'm going to go ahead and bet against a breakout. So I shorted this one. I didn't do options. I just shorted a few shares and I'll see what happens. If spot gets above the 50-day moving average, I'll go ahead and take that off. Again, because I have a cautiously bullish short-term trading call, just remember that I am still allowing myself hedges where I think it makes sense. Now, this again was I was kind of pushing the boundaries here for a short because if you see here, I circled this action here, which some could call an abandoned baby bottom. What is an abandoned baby bottom? Well, it's where the stock price gaps down and then gaps up the next day. Here, if I just did a 2-day chart, you would see very clearly that this gap down and then gap back up created an abandoned baby bottom. What we say happened here is that basically shorts or sellers got trapped. And for people who regret selling down here, they will scramble to buy back in. And so that's what kind of creates the bottom, that basically sellers and shorts are exhausted. So like I said, I'm pushing things a little bit here, but this push on 50-day moving average resistance looked pretty tentative, and the market filled me in right at that line. Okay, let's stop. Let's go back to bullishness. So SoFi is one of those that I love during oversold conditions. Um, if you want to see my previous discussion about this head and shoulders top, I put a link to that blog post in the captions. But anyway, I love this kind of action. Picture perfect test of the 200-day moving average support and then a rebound off of it. I happen to notice in briefing.com that there was a lot of call actions volume, sorry, a lot of call volume. I went on to the price dashboard, and sure enough, I saw calls trading hand over fist. So not only did I buy shares, I also speculated on some call options. And hopefully SoFi can get back close to 50-day moving average resistance as a minimum move. So we'll see what happens there. Okay, let's take a look at Netflix. If you recall, Netflix was one of the generals that I thought um, was going to be one of the last ones shot as it came down finally below its 50-day moving average support. I was a little over aggressive by buying a call option here that expired this next day. And then I took my eye off the ball and didn't see this nice 1, 2, 3 bottoming action in place. And actually, you'll see this 1, 2, 3 bottoming action in a bunch of different stocks. Let me go to NVIDIA. NVIDIA didn't have the 1, 2, 3, but it had a huge pop, 6.4%. It allowed me to get out of a call spread, calendar call spread, where the short side expired 0 last week, and I still had the long, so I got out of that total net um, gain on that. So that was good. But again, as I've claimed before, this bearish engulfing top tells me that NVIDIA is going to be stuck for quite some time. And right now, of course, it's in bearish position. Oh, and I should mention, just so that I'm clear, when I say a stock is in bearish position, but I am making bullish trades, those trades are only short term, betting on a bounce back to some important resistance level, at which time I fully expect the bear market to rear its head again and push the price action down. If that resistance gives way, then I can say that the overall market is back to being bullish. So again, just to be clear, when I say my short-term trading call is bullish, it's just betting on a bounce from current levels. But the overall sentiment and tenor of the market is bearish until the key indicators that I showed you, the key indices, S&P 500 and the NASDAQ, are above the 200-day moving average. It's a lot to expect IWM, the ETF of small caps, to get above the 200-day moving average. So let's take a look at some other high flyers. Like let's look at a quantum computing stock, IonQ. Huge update today, 16.7%. It's above its 200-day moving average. This is my favorite quantum computing play, so I'm putting it on my buy list. I will feel much more comfortable chasing IonQ here if it pulls back a little bit and cools down and holds 200-day moving average as support. I don't want to chase this only to find out that the stock still had to test and solidify its 200-day moving average as support. So we'll see what happens, and I will post or video on IonQ later. Let's see, what are some other big movers? Of course, Reddit. Reddit I posted about. Oh, this is technical beauty, but I just could not bring myself to speculate on this one because the drop was so dramatic, so big. So notice again the 1, 2, 3 bounce pattern here. So Reddit first dropped out of this consolidation period. Sorry, I didn't put some bars in here, some lines in here to show it clearly, but this is a consolidation period. Depending upon where the stock goes, will determine will separate bullish from bearish. So it popped, sorry, if it had popped up here, I would have been bullish, but it dropped and Reddit became bearish. So look at this. It dropped first, 10.6%. And then it dropped even more the next day, 11.1%. And then the big kahuna, 19, essentially 20% drop. But like magic, the sellers stop right just about on a dime at the 200-day moving average support line. That is just beautiful to have this thing pop right back up the next day with a 14.4% gain. Um, and, based upon my positioning, my trading strategies, I might have been aggressive enough to buy into it yesterday, but like I said, I just couldn't bear to do it just because I was overly focused on just how extreme this selling has been. But obviously now this selling opens up a huge amount of upside. I mean, Reddit was down what, essentially 50%. So if Reddit somehow one day gets back to those highs, it's going to be a double from these lows. So just like IonQ, if I do chase Reddit, I really wanted to cool down a bit, even test the 200-day moving average again. Actually, no, in this case, I don't need to test it again because I consider support to be confirmed. I just need the action to cool down a little bit to reduce the amount of downside risk. Let me show two more stocks and then we'll wrap this up. Another one where I did a buy, which was Broadcom. I identified this yesterday, so I was prepared to buy into this one. This is a case where Broadcom tested 200-day moving average support perfectly before earnings, and I consider this support confirmed. So today, it's a little late. Technically, I should have bought it yesterday, but I only noticed it after the close yesterday, and I bought some shares here. And just like a lot of these short-term plays, I'm hoping to play this for at least a bounce back to 50-day moving average resistance. And then one where I did not get a trade in, but I think is back into bullish graces is Oracle. And again, sorry, tradable bullish graces is Oracle. I pointed this out again on my last blog. I like the way that it held this support line here that I drew as the basically the bottom of this previous pre-election consolidation. You can see here, let me blow it up. Actually, you can't really see if I blow it up, but right here you can see that the low from Oracle's earnings stopped right on a dime right there, and then buyers took it right up. I'm not surprised at all by this follow-through buying. 4.7%, but I was a little too conservative in my positioning. Sorry, in my positioning at the bid, and my trade just never went through. I was trying to do a call options trade on this one. So, I will keep Oracle on the board and see if I can take advantage of any kind of pullback before it gets back to these resistance levels here. So hopefully that was helpful to let you know what's going on in the market. I know it's chaotic out there. Just hang in there, whether you're bullish or bearish. There's opportunities in this kind of market to go either way. And oh, I'm just realizing before I close this out, I didn't even discuss the VIX really quickly because in my last blog, I talked about how I couldn't get bullish. I couldn't get aggressively bullish until volatility index either spiked really big or had a big implosion. So, of course, what the VIX does, it does have a nice strong pullback, so 10%, and I bought some more put options on VXX, which is the um, ETN equivalent for the VIX, but it's not quite an implosion because yes, it came down below the low of the previous jump in the VIX, but it wasn't dramatic. Like this is dramatic here when the VIX collapses 24%. This is dramatic over here when the VIX collapses 28%. So this is a nice implosion, but it's not a big implosion, the one that gets me aggressive. So I won't be surprised if the VIX just jumps right back up tomorrow or even on Friday, but we'll see. So anyway, like I was saying, let me wrap this up here. Whether you're bullish or bearish, I see lots of opportunity in this market. Um, but I am short-term bullish because I'm looking for an oversold bounce. Just a matter of at what point that oversold bounce begins. But I'm overall bearish on the stock market until the S&P 500 and or the NASDAQ get above their 200-day moving averages and hold those breakouts. And it's one of those mixed days. And that's just the way it is. So I will, thanks for checking this out, and I will talk to you the next time. Take it easy.